Welcome back. This is the Alchemist Nation podcast. My name is Walter Morello. I get the pleasure of interviewing real estate professionals all across the country. Today, I have a very special guest. Mauricio Rauld is actually a syndication attorney. So he specializes in helping people gather real estate deal money legally so you don't get sued from borrowing people's money. Mauricio, welcome to the podcast.
Well, thanks for having me. Really appreciate it and looking forward to it.
So one of the questions that I get all the time is, can I just raise capital? Can I just go ask people for money and go buy real estate? I know that's a resounding no. What are some of the reasons that you can't do that?
You can do it if you don't want to end up in jail or, I kind of joke about that. I mean, look, when you're raising money from individuals, especially passive investors, then you're issuing securities, which is, you don't really think of it. It doesn't really quite make sense. Like, I'm not really issuing securities. I'm just raising a bunch of money and buying real estate. But somehow people tell me, I've got to talk to an SEC attorney, which is the Securities and Exchange Commission. Like, why in the world are they bugging me? And the answer is because anytime you're taking money from passive investors, meaning you're taking money from people, you're the one generating the return and doing all the work and putting it all together, and they're literally writing you a check and going home and expecting you to generate the return and send them a check, hopefully once a month or once a quarter, you're issuing securities. And it doesn't matter. This is where people get caught up in. It doesn't matter how you structure it. It doesn't matter that, this is a joint venture, or this is a LLC, this is not an LLC, this is a profit sharing agreement, or TIC. It doesn't matter. The structure itself doesn't matter. If you're running the show and doing all the work and generating the return, you're in the business of issuing securities, which means you've got to follow securities laws, both at the federal level and at the state level. So every state that your investor resides in, we've got to make sure that we're covered under their state's laws. And there's some relatively easy ways to do that, but you've got to be aware of them because it's not automatic.
Right. So I did not know that it was each state level. I've heard some really crazy stories about some of my buddies being sued by the SEC. Went and raised capital, great deal, everything seemed fine, and they were getting investors' money. And now this particular situation, this investor was perfectly, legal what he did because he didn't set up the deal. He was just, somebody else set it up, and he was just going in and bringing money. But it turned out that they had walked away from the deal, and they had done something illegal, and he ended up getting tied into it for years of litigation, even though he had no actual fault, no knowledge of what had happened. So how does somebody protect themselves? Like, I guess let's go back to the beginning of raising capital. Now, there's a difference between private money for interest-only notes or seller financing, and what we're talking about is actually sharing equity interest in the actual deal itself. That's what separates securities?
No, not necessarily. So this is another, and I talk about this I got that book, The 5 Things Every Syndicator Must Know to Stay Out of Jail. And I talk about that, I think in chapter 1, where notes are also potentially securities. In fact, most of the time they are securities, and there's some ways you can, rebut that presumption and you can get away with not complying with the full securities things. But just because it's a note doesn't somehow magically get you off the hook either. Now, if it's an owner financing, and if it's a short-term loan, if it's a loan to your buddy, I mean, there's all these exceptions, that are out there. But issuing debt as opposed to issuing equity, again, remember what I said at the beginning, the structure itself doesn't matter. So if you're in the business of raising capital and you decide, well, instead of giving out equity, I'm going to give 5 different people 5 different promissory notes, and I'm just going to pay them a 10%, and it's not secured or whatever. That's going to be considered what we call an investment contract, and that's going to be a security as well. And you're going to have to comply with the same rules. And what's important to remember, what I always try and frame, I like to frame things because it's not your job to understand every single statute and law. I mean, that's what your securities lawyer is there for, but it's your job to at least get a basic understanding, the contextual, like where does everything fit in? So then you can have intelligent conversations with your attorney, or when something happens, you're like, wait a minute, that doesn't sound quite right. Let me talk to my attorney. And the contextual thing that I like to keep it as simple as I can is when you're in the business of issuing these securities, whether they're promissory notes to 5 different people, or their equity, or their tenants in common agreements, or their profit sharing agreements, or their high fives or handshakes, you have to understand that there's really 3 things you have to worry about. Number 1, you have to register that security, that syndication, with the SEC, the Securities and Exchange Commission, or you must find an exemption to registration, or it's illegal. It's that simple. Register, find an exemption, or it's illegal. And in our world, we don't register securities. That's just kind of basically going public. It's going to take you years. It's going to cost you 6-7 figures. You don't want to go through that whole regulatory compliance nonsense, for lack of a better word. You don't want to do anything illegal, right? And I always stress, illegal is not Bernie Madoff. It's not just ripping off your investors. I mean, clearly ripping off your investors, intentionally defrauding them. Everybody knows that's a no-no. But even, failing to disclose relevant information to your investors. Hey, I didn't tell them that, I was getting a little bit of compensation here on the side because I'm also the real estate broker or whatever, and I'm getting paid. Or I didn't tell them that this really belongs to my brother, and or anything like that. That has to be disclosed. So that could be an illegal. So we're always looking for exemptions to registration, which is the world that I live in, and that's what I spend all my time doing is figuring out what exemptions do my clients want to rely on, and once we pick one that's best suited for their deal, then we just make sure we follow the rules.
So basically, we're aiming to not have to register with the SEC. What you're looking to do, so I guess these 506Cs and 506Bs are actually exemptions. They're not actually a registration with the SEC. It's a statement saying we don't have to register as long as we fall within these parameters.
That's exactly right. And in fact, I don't want to say there's nothing that we send to the SEC for approval. We don't send them a copy of our business plan. We don't get it pre-authorized. We don't send them a copy of our PPM and say, hey, Mr. or Mrs. SC, is this okay? We don't do that with the 506Bs and 506Cs. Interestingly, we do that with a Reg A, which we may or may not get to talk to, but there is an exemption that you do that. But in the most 95% of the people rely on these 506B or 506C exemptions. And the only filing that we do, the only reason the SEC even knows what we're doing, unless obviously somebody complains, is we do have a form filing, a notice filing that we file with the SEC that just basically says, hey, we're raising a couple $1 million to go buy an apartment building, and we've got a few non-accredited investors, and just basic information. Nothing, again, no approval seeking. I'm just giving you some facts. And in fact, that's how when you see the statistics from the SEC, that's where they're getting them from, all these, what we call these Form D filings. And that gets filed with the SEC, and a copy that gets filed in every single state where your investors are, which is how those states know what you're up to. And most of the time, making that filing within the designated timeline in those states is sufficient to kind of make sure that we're complying with the state level. Because luckily, these 506B and 506Cs, the reason they're so popular, the reason 95% of the people use them is because they preempt state law, which is just a fancy way of saying we don't worry about the state securities laws other than the anti-fraud provisions. I mean, we still can't mislead and do all that stuff. But I mean, can you imagine a world where you had to, you had a deal and you had investors in 7 different states, and you'd have to not only go hire a local attorney in every single state, you'd have to have those 7 attorneys review the statutes and make sure that your particular deal complies with all 7 statutes plus the federal statute. And if it might comply with one but not the others, and it's just a nightmare. So the nice thing about 506B, 506C, we worry about the federal statute, we comply with those rules, and they're not super complicated. There's things you've got to follow, and as long as you know what they are, that your securities lawyer walks you through and says, you can do this, you cannot do that. It's like 5 or 6 things to do. It's not super complicated. And then you comply with that, and now you have a legitimate offering, a syndication, a securities offering that's compliant with federal and state securities law.
And so it's really just preventative measures, right? Like you're really just making sure that you're doing things ethically, morally, and legally, and you're going out and you're raising capital in a way where, as long as you do this and you have this structure in place, if ever the SEC comes around and says, hey, you know what, we got a complaint, you have backing, you have something legitimate saying, no, we've done everything the right way, we've complied. This is how we've organized our organization.
Yeah, the first thing, to be honest with you, it's usually not the SEC. The SEC is a little bit bogged down. They're busy. They're understaffed. So unless it's a huge $100 million, $50 million, or something really, like a cryptocurrency thing where they're really into it, usually it's the states that get all up in arms, and you usually hear from the states. But the first thing they're going to ask you is like, hey, where's all your documentation? You're required to provide a certain level of disclosures to your investors depending on the exemption you require. What are they? Send me everything that you have sent to your investors. Get me every communication, everything you've done, and responding to them with, oh, here's my articles of organization of my company is going to raise a lot of red flags. If instead of that you say, well, actually, let me have my SEC lawyer send you our PPM and our subscription documents, which are usually in the 100 to 150 page range, and it's all signed by investors and there's signatures all over the place. My experience is the SEC has better fish to fry, and they're looking for low hanging fruit, not your deal that you crossed your T's and dotted your I's.
Absolutely. I like the idea of being prepared, prepping yourself for the worst case scenario, and then being able to focus on your investment and making sure that your investment runs smoothly so there are no issues, building your relationships with your investors, making sure everything runs properly. So Mauricio, I got to ask the question, what is the difference between, there's three different structures that I look out there, and you've got the REIT structure, you've got the typical investment strategy where you go and you take something public, and then there's syndications between the 506B and the 506C. And I know that those are typically relationship based. One is deeper relationships, the other one's more sophisticated investors that it relies on. Why wouldn't somebody just go and raise capital as a real estate investment trust instead of doing the syndications? Why wouldn't they just move in that direction?
Well, a REIT, a real estate investment trust, is a REIT, which is typically, it's on a public exchange. They've gone through the registration process, and that took them years, cost them probably seven figures. And then REITs are very heavily regulated. I mean, a REIT has to, by law, distribute most of their profits. There's got a lot of tax benefits and stuff, but they're under it's like a mutual fund. Like, why don't you just put together a mutual fund? Well, you've got to get it registered. You're under the regulate. I mean, all that stuff. It's a nightmare. Like, you don't want to go. I mean, you don't want to get anywhere near that. A private offering is just that. It's private. Like, nobody needs to find out about it. Yes, you're regulated, but you're really self-regulated in the sense that you don't have to run it by anybody. You don't have to get an approval unless, again, you're doing this Reg A stuff. But typically, the attorney is going to be the one who prepares all the documentation, makes sure that you're complying with the law. And the SEC is not going to bug you unless, of course, something goes wrong. Is typically how these things start to come back up. Somebody doesn't like what's going on. They're not getting their money, or they've lost their money. They pick up the phone, they call the SEC, or they call the state regulator, and that's when they'll open up an investigation, an audit, really what I call it. And like I said, first thing they're going to do is, hey, show me that you comply. And at that point is when they start digging in. It's really after the fact. It's not a pre-approval or any sort. So it's really important for you to have a lawyer who specializes in this stuff, who knows exactly what disclosures need to be in the documentation, what level of disclosures, and then just puts them in there so that in the event, hopefully unlikely event, that somebody digs around and you get not a nasty letter, you get a letter from a regulator that says, hey, sounds like you're doing something, an unregistered, which you are, it's an unregistered offering, explain yourself. You can explain yourself, and there's no big deal.
So other question. So why does it seem like the syndicators are running a new capital raise every single time they go after a new building? Why aren't they just running under one entity and just bringing more people in?
It's easier. I mean, there's two types. In fact, I'm seeing a lot more of the latter now, especially after COVID and everything. A lot of people are calling me now with this idea of putting together a fund. So what you're describing is a difference between a project-specific raise, which is I've identified a piece of property and I'm going to raise capital for that property. I need a down payment. I know exactly what my strategy is, my value add. So I need this much money to upgrade it. And here's my return, everything like that. With a fund, which is more like what you're describing, is really a blind fund. The investor has no clue. Well, they have a clue because you're telling them kind of the parameters in your fund criteria, but they don't know what buildings you're going to go buy. And so it's much harder for a syndicator to get money from an investor unless they have a really great track record. Somebody like, throw out a name. He doesn't actually do funds, but I mean, the great Ken McElroy. I don't know if you've heard or met Ken.
I know Ken, yeah.
One of the Rich Dad advisors.
Yeah.
I mean, he's got a great track record. And so when he has something to do, people, they write him a check because it's him. So if you've got a great track record and people know you, they're betting on you. They're betting on the jockey. They don't have an opportunity to review the building and look at your underwriting and assumptions and question your assumptions or make a more conservative assumption. They have none of that. They basically just be like, oh, I trust you. Here's my money, and then go do it. So from a syndicator standpoint, it's a dream. Like, have all the money in the bank and then go shopping. But it is harder. And so if you're a first-time syndicator or you're just getting started going, you don't have a track record. And then the other reason, of course, is that once you do a fund, then it's the same rules for all of your deals. If you do a project specific and a different offering, then you can structure each one in a unique way. And, there's plenty of different structures. And sometimes it's more of a cash flow play. Sometimes it's more of an equity play. Sometimes it's more of a tax play. And so you can pick and choose depending on the building that you're buying.
Yeah, I love, Mauricio, that you've been in this for so long. How long have you been doing this specific type of
See those gray
this
hairs? Do you
law?
see those gray hairs that are popping up here? I've been practicing securities law since 1999. So 20 years, 21 years now, or maybe 22 years.
No kidding.
First on the litigation side. So I used to represent sort of the Merrill Lynch's and the American Expresses and the JP Morgans, those Merrill, and I would be a litigator. So those guys got sued and I would defend them, hey, whatever it was. Now, probably 15 years ago, I started doing the transactional side, which is much more fun because where everybody's aligned and everybody's going in the right direction. There's no friction between you and the opposing counsel. And then about 7 or 8 years now, I decided to do this exclusively. So at some point, when I started my firm, you do whatever puts food on the table. And then over time, I narrowed my practice. And then about 7 or 8 years ago, I just decided, hey, I'm just going to do syndication 100% of the time. And that's all I do. I mean, I've got a real estate attorney in house, but my personal practice is 100% real estate. Real estate is probably 99% of my practice, but it's all real estate syndications, either under the Reg D exemption. So that's 506B or 506C.
That's amazing. So I already told Darina, in fact, she told me, she said, when it's time for go get this private placement memorandum set up, you're the one doing it for us, just because you're the one everybody in our community uses. All the syndication guys that have been on my podcast have been using you. So, Kenny Wolf and Matt Pishaney, like these are people who trust you. You've done a great job for them. So when we do go forward with this, and you'll be getting a call from me sometime within the next couple of months, probably January, February, I want to start getting it put together. I probably won't start with the fund, but the fund is the direction I want to move into because it's simpler, it's easier. But I do want to start with a few deals, and I'm probably going to learn from you. Hey, what are the big guys doing as far as, and by the way, for everybody listening, ask the professional who does the work. What are the people who are ahead of you already doing? What are they lining up? What is their suggestion? Why are they doing things the way they're doing? Because the fund may not be the right direction to start with, but you may want to start with something as simple as, how do I go and get a 40 unit deal? Like I want to go and raise $2 million, starting small. And what's the easiest direction and format to go in? Do I take 50% equity? Do I take 20% equity? Is it 10% equity? And what would you, Mauricio, to start off somebody who's getting into the game and say they're going after a $1 million deal or a $5 million deal, and they want to syndicate and get this leveled up for them for the first time? What would you suggest is the best step for them to take? They've never talked to a syndication attorney. Like, I guess I already know the answer. What's your contact information? What's the easiest way to get in touch with you? I'm like, as I'm talking, I already know the answer.
Look, you can always find me at the premierlawgroup.net website, and there's a little contact us, and I'm happy to do a consultation with anyone. But you're right. I mean, I've done hundreds and hundreds and hundreds of these, and so I've seen every single way. I've actually come up with my own creative structures myself, which we implement with some of the clients. But it all starts with what are you trying to get your investors, right? Like, are they looking for cash flow? Are they looking for equity? Are they IRA investors that don't care about anything until 20 years from now? Are they looking for a tax break? Start with the end in mind and figure out what it is that you're trying to provide value to your investors. At the end of the day, you start with that. It's all about the investors. What do they need? Not what you want. What do they need? And then I just say reverse engineer it. Once you've figured out what you're trying to get your investors, then just throw something on a spreadsheet and then see I would literally start, if you'd never done one before and I would literally tell people, throw up a spreadsheet with a particular deal and just do an 80-20 split. Money comes in, 80% goes to the investors, 20% goes to you, and then see what comes out. And if the returns are too great, then maybe you go to a 70-30 or 75-25, or maybe you do it if it's not as great. So maybe you throw in a preferred return in there, or you can start messing with it. But if you've never done one before, put it on a spreadsheet. That's what your underwriting is about. Start with a 80-20 split, which is probably the most common, anywhere from a 70-30 to a 75-25 to an 80-20 split. Don't even worry about the pref. I mean, a lot of people do an 8% pref is probably the most common out there, an 8% pref, and then an 80-20 or 70-30. But just start simple. Put your numbers in a spreadsheet, 80-20, see what happens. And then, like, wow, these returns are way too high. I don't want to be offering my investors. So maybe you dial it down a little bit or give them a nice little pref. Or crap, this is a really tight, skinny deal. Like, if I give them 80%, that's not going to be a great return for them. So that either means give them a little bit more, or maybe the deal's not worth it because it's so skinny. And there's not enough meat on the bone. Maybe it's time to go to the next one. And that's the whole purpose of your underwriting.
Absolutely. And how often are general partners actually bringing capital to the table?
You know, I would say the vast majority of them are. I don't keep stats on it, but I mean, I'm going to guess it's probably 2/3 to 3/4 of the time they're actually bringing capital, and I mean real capital, because a lot of times they'll just take their acquisition fees or whatever and put them in the deal, which that's putting capital. I mean, they would have been in their pocket and they're putting it in the deal. But most of the time, most in the marketplace generally likes to see sponsors put in something. It doesn't have to be a huge amount of money. It might even be 20 grand or 50 grand or something. But if you can show them that you got a little bit of skin in the game, it tends to go better, and the market likes to see that. It's not a requirement. There's nothing in the law that requires you to put any money, your own money. Plenty of people don't put any of it, but the market generally likes to see skin in the game.
I absolutely concur. For me personally, I like to see it. I know when any of the syndications who approached me have told me that they were putting money in, I was like, okay, I like that. To me, that means you get some skin in the game. Your money's locked up with my money. It's a really comforting feeling. But again, if I really trust a syndicator, this is somebody I've worked with before, or they have a great reputation. Like if Ken McElroy came to me, like I'd be like, dude, just take my money. Like I just want to be able to talk to you more often. Please, let's do this deal.
Some people have that reputation, and Kenny's
Yeah.
not the only one, but where literally people would be willing to write a check even before they see anything. It's like, just let me know when your next one in. I want to make sure I'm in, and here's my pre-check almost. And then when you have one, just apply it. And
100%.
that's the power of the relationship. I mean, this is a relationship business, just like any other business. And the better you do, and the better you take care of investors over time, that reputation builds on it, and you'll get to a point where people just know you, and you'll have not only repeat investors that keep coming back to you, but they'll then refer people, just like your people refer people to me all the time, because presumably I'm doing a good job. Same thing with a syndicator. If you're doing a good job taking care of your investors and performing, not only will they come back for more, they'll invite their friends, which is ultimately what you're looking for.
It's about the referrals. It's a long-term business. And I think that's, you got to look at real estate long-term anyway, right? If you're getting in this is not a 1-2 year game. This is a 10, 20, 30-year play. And it's about building really strong relationships. Mauricio, I did not realize that you've been doing it for this long. That's over 22 years you've been in securities. That is,
I mean, what helps me is the gray hair. Before I had the gray hair, I looked a lot younger than I am. I mean, I'm going to be pushing 50 here in a few years. But
nice.
yeah, I've been doing it since 1999 is when I joined a litigation firm here in Southern California, and spent the first 7 years of my life in a courtroom and in depositions and in arbitrations and in a appellate court, and kind of figuring out that part, which actually helps now because I know that's the end game. I know what potentially could happen. So my job now is to make sure we do everything properly to avoid getting to a point where somebody can sue you because you've done everything right. That's the goal.
The idea is protect, prepare. You never want to go there. It's just, let's maintain this all the way through. So Mauricio, you've given up so much value, huge, tremendous value for everybody on the call. Before I let you go, I got to ask the same question I ask everybody on this podcast is 3 pieces of advice. You go back to your 20-year-old self and give yourself 3 pieces of advice that would help you launch your life better, get to the position that you're at now. What 3 pieces would those be for young 20-year-olds just jumping into this now?
If you're thinking about investing in real estate specifically, there's a great quote that says, "Don't wait to buy real estate and wait." So that's a good piece of advice if I'd given that advice back to my 20-year-old. The other good advice is just work more on yourself than you are probably now. Success is something that gets attracted. This is coming straight out of one of my mentors, Jim Rohn. But Jim Rohn used to say, success is something that you attract by becoming an attractive person. And that means just work on yourself, better yourself, get yourself more skills, get more things so you become more attractive to the marketplace, to somebody of the opposite sex. If you're looking for a relationship, like work on yourself more than anything and improve yourself. I've been a huge into personal development. And then, just read a lot. I think reading is, especially now with the internet. I mean, I'm not just saying books. I mean, I read a lot of books, but just there's so much information out there for free now. Like you can learn about you can take any personality and you can just find all kinds of information. So if you're interested in a particular topic, there's no excuse not to get fully educated. Again, back in the day, you just had to rely on experts, like even Dr. Google, right? I mean, now it's like anything that pops up, you can almost become a doctor. It's kind of scary. But yeah, those are probably the 3 that come off the top of my head.
I love that, Mauricio. That's some of the most powerful advice. Don't wait to buy real estate and wait. And then make sure you focus on yourself, your own personal development, because your income will grow to the extent that you do. And then read books, right? And not just, fantasy novels. You're talking about personal
Oh yeah,
development books.
I don't read.
Uh,
Yeah, I don't remember the last. I think it was a John Grisham book. Back in 20 years ago. Yeah, they're all. Most of my books are usually either personal development books, business books, or biographies. Those are the three things that I primarily work on.
so if I could ask, what would you say is the best book you've read recently, gave you the most change of perspective?
Uh, Recently, it's probably a book called Traction by Gino Wickman. That's
Nice.
just got a great. If you have your own business and you're just thinking of how to scale it, what's really nice about that book, and you're nodding, so I assume you've read it, is it takes
Twice.
principles from all these other great books. Or another great book, for example, is the E-Myth. Right,
Yep.
the E-Myth is a great book, and Traction kind of builds upon that. The One Thing is another great book. It talks about, the 80-20 rule, and not everything being, equal. And so the Traction kind of takes all those principles and kind of puts them all in one place. So, but those are the two books, The One Thing, the E-Myth for sure, Traction. The Slight Edge is another great book, which is very similar to Darren Hardy's book, The Compound Effect. Those
Compound
are
effect.
almost identical books, by the way. And I give the edge to, even though I'm a huge Darren Hardy fan, I give the edge to I think it's Steve Olson, who wrote The Slight Edge, just because he wrote it first. So I'm like, these are the exact same principles and the exact same book, but The Slight Edge came first. And so that's another great book I would recommend. I got a laundry list. Rich Dad Poor Dad, don't forget that one too.
Absolutely. No, Marcio, the Slate Edge I haven't read, so I'm going to go
Oh my
read it.
God, you got to read that. Have you read The Compound Effect?
I have the
Yeah,
Compound Effect, the
it's
Power
very
of Habit.
similar to that, but it's a slight edge. It's just that little progressive increment changes and consistent changes will then, it's like a lever and it will push you up. I would highly recommend The Slight Edge.
I love it, man. But thank you so much. Books are definitely, like you said, they're the third. They are part of my life. It's what I do. I've read over 300 books in the last 5 years, six
Wow.
years, and
Nice.
I book a week, man. And
Yeah.
it's people like you who give me, now I'll go read The Slight Edge. You give me that little extra piece that I was missing.
Yep.
So I definitely appreciate I always learn something. Mauricio, I learned so much from you today. One more time, what is the easiest way to contact you?
Yeah, if you want to just get websites, premierlawgroup.net. If you want to get a copy of that ebook, The 5 Things Every Syndicator Must Know to Stay Out of Jail, just shoot me an email at jail@premierlawgroup.net, jail@premierlawgroup.net. And then my YouTube channel, even though I've been a little bit MIA the last few months, I try and put a lot of content. Actually, one of the ones that we met originally, I think we first met in Boston, that whole thing is on there. That whole
Nice.
20-minute or 30-minute presentation on stage is actually on my YouTube channel somewhere. So check out the YouTube. It's just under Mauricio Rauld, and hopefully that'll add some value to your listeners.
Awesome, brother. I appreciate you so much. I'm actually going to have Darina send you a message so we can get all that contact. I'm going to put it on the drop
Yep.
page.
Awesome.
For everybody at home, go to gualteramarello.com. Check it out. We've got more interviews with some of the people that Mauricio is actually working with to do syndications. You can see the size of the deals they're doing, the complexity of the deals they're doing. And it's just a testament to having a great syndication attorney at their back, knowing that they have the confidence to go forward and do these deals. They know how to raise the capital. They know what to say live legally so that they can actually raise capital correctly. Again, Mauricio, thank you so much for everything you do. You give investors a way to invest on a bigger scale. We appreciate you.
Thanks for having me. Really had a good time. Thank you.
Thank you, brother. Cheers to your success, man.
You
Enjoy the
too.
rest of your day.